Welcome to the Deep Dive, your essential guide for navigating the most important earnings calls out there.
Great to be here.
Today, we're really digging into USANA Health Sciences. That's ticker USNA. We're looking closely at their second quarter 2025 performance.
And yeah, it was quite a quarter. Lots to unpack, really. A company seemingly in transition.
Definitely. So let's start with the big picture. USANA Health Sciences, well, they put up a pretty robust Q2 2025.
The headline numbers looked quite strong. Adjusted earnings per share really surged, came in at $0.74.
Yeah, 74 cents. And that's a huge beat, right? Analysts were looking for something closer to, 54 cents?
Exactly. So a significant beat. It's about a 36% jump year over year. That definitely sets a positive tone right off the bat.
And what really stands out, if you look at the big picture, is how that EPS number was backed up by revenue.
Right. Revenue hit $236 million. That's up 11% from last year. And again, comfortably ahead of what people were expecting.
And the balance sheet story is, well, pretty compelling, too. They're sitting on $151 million in cash.
And importantly, zero debt. They paid back that line of credit they used for the Hiya acquisition.
Zero debt in this kind of market. That's more than just a strong balance sheet. That gives them incredible flexibility, wouldn't you say?
Absolutely. Strategic flexibility is huge. Now, it's worth noting the GAAP EPS did dip slightly.
Okay.
But the adjusted figures, which, often paint a clearer picture operationally, they were undeniably positive.
Gotcha. But there was one number that sort of jumped out for maybe a different reason. The active direct selling customer count.
Ah, yes. That saw a decline. Went from about 468,000 down to 418,000.
That feels significant. It's definitely a key point we need to dig into more during this deep dive.
Agreed. So let's do that. Let's unpack this and look deeper at the pivotal financials.
Okay.
Beyond those top-line numbers, adjusted EBITDA was around $30 million. Solid. That's up 13% year over year.
And operating cash flow.
$13 million for the quarter. Pretty healthy.
And that zero debt status you mentioned, it just feels particularly strategic for a company like USANA.
It really is. You think about the direct selling world, it can be pretty capital intensive sometimes. Having no debt, that gives them serious agility.
Like you said, they can jump on acquisitions like Hiya without worrying about hefty interest payments.
Exactly. It could be a real edge over competitors who might be more leveraged. Management definitely flagged this as a source of flexibility.
Makes perfect sense. And you heard CEO Jim Brown really leaning into that 11% consolidated net sales growth. He seemed confident, reaffirmed the full year outlook.
But it's also clear they aren't just, resting on their laurels, especially around modernizing that core direct selling model.
Yeah, it sounds like they know they need to evolve things there.
For sure. And this is where it gets really interesting, I think. They're making a pretty big strategic pivot, rebranding associates to brand partners.
Brand partners. Okay, is that just semantics or?
Well, they say it's not just a name change. It's meant to reflect a more collaborative, more strategic relationship with their sales force, a signal of how they view their distribution network.
Interesting.
And crucially, they've revamped the compensation plan, too.
How so? What's the goal there?
It seems twofold. One, simplify the whole model so new brand partners can actually start earning money faster.
Ah, okay. Address that early ramp-up challenge.
Right. And two, reward existing partners for activities that, genuinely drive growth, incentivizing the right behaviors more quickly.
That sounds like a smart way to tackle both recruitment and retention. It's a tough market out there for direct sellers.
It really is. And these new incentives, they're rolling them out in phases during Q3. The plan is for a full launch by October.
And they're backing it up with tools too, right? Better business building tools.
Yeah, things like new data-driven recommendations. They're exploring social media tools more. And they even mentioned AI potentially playing a bigger role in future tools over the, coming quarters and years.
So empowering those brand partners.
That seems to be the idea.
And there's that global convention coming up soon too. August in Salt Lake City.
Right. They're expecting around 3,500 brand partners. That's a big platform to announce new products, new sales incentives, really get people energized.
Especially important given all these changes they're making. You need that buy-in.
Absolutely. That event will be key for rallying the network.
Okay, so how does all this connect to their diversification?
Yeah.
Because the acquisitions, Hiya and Rise Bar, they seem to be doing really well.
They really are. They look critical for the overall growth story now. Hiya, the kids' health DTC business. Impressive top-line growth year over year and better profitability, too.
And didn't they mention a Disney partnership for Hiya?
Yes. That's a really interesting move. Co-branded multivitamins, Lion King and Princess's themes.
Wow, that's a smart play. Taps into a huge trusted consumer base.
Definitely. And they're still working on integrating Hiya, logistics, manufacturing synergies. Plus, they're looking at taking Hiya international, maybe 2026 or later, leverage USANA's global network.
Makes sense. And Rise Bar, the protein bar company.
Also strong. Double-digit top-line growth. They said order activity with key retailers was solid.
So these acquisitions, they're not just like bolt-ons, they're actively diversifying the company.
Exactly. They strengthen the financials and expand USANA's reach into broader health and wellness areas beyond just the traditional direct sales channel.
Which brings us back to that challenge we flagged, the drop in active direct selling customers. How did management explain that?
Well, they pointed to a couple of things. One, just general macro uncertainty, which, affects a lot of companies.
Sure.
But significantly, they also felt it was due to people anticipating these new incentive program changes, kind of a wait and see approach.
So brand partners maybe held back a bit, waiting for the new, simpler plan before really pushing or re-engaging.
That seems to be the narrative. And management sounded optimistic that this trend will reverse in Q3 as the new incentives roll out.
Because it makes it easier for new people to earn money sooner.
Right, making the opportunity more accessible, more immediately rewarding. That's the hope.
What about other risks, like tariffs, especially with China?
Yeah, they touched on that, said the impact so far has been minimal.
How come?
Seems like proactive sourcing strategies and some inventory building by their operations team really helped, especially regarding China. They did see some increased buying there due to the tariff uncertainty, but overall they managed the supply chain well.
Good execution then. Okay, let's look ahead. Full year 2025 guidance. What did they lay out?
Consolidated net sales, they're guiding between $920 million and $1 billion.
And how does that break down?
Direct selling is pegged at $775 million to $840 million. And Hiya is expected to contribute a pretty hefty $145 million to $160 million.
Wow, that Hiya range implies what, 29% to 42% year-over-year growth? That's huge.
It really is. Shows how significant that acquisition is becoming.
And on the profit side, adjusted EPS and EBITDA.
Adjusted EPS guidance is $2.35 to $3. And adjusted EBITDA is projected between $107 million and $123 million.
Okay. But they did flag some potential headwinds in Q3, didn't they? Margin pressure.
Yes, exactly. They expect some short-term margin pressure in the third quarter.
Why is that?
Mostly due to increased costs tied to launching the new compensation plan, promotional costs there, and also spending on Hiya customer acquisition.
So spending money to make money, basically.
That's how management is framing it. Necessary strategic investments for sustainable long-term growth, not just, a blip. They seem willing to take a short-term hit for the longer-term payout.
Right. Playing the long game. It fits with that strong balance sheet picture.
It does. And connecting that to capital allocation, they talked about share buybacks being opportunistic. It's something the board discusses regularly, looking for efficient ways to deploy capital.
So returning value to shareholders is on the table, but they'll be smart about when and how.
Seems so. And the M&A team is still active, apparently, always evaluating potential deals, especially things that fit that health product profile, like Hiya.
They also mentioned needing to build cash back up a bit before any major new deals, right?
Correct. So they're looking, but they're disciplined, methodical about it.
Okay, so summing up the overall vibe, how did the market take all this? What's the sentiment?
I'd say cautiously optimistic, maybe leaning towards bullish, actually. The market reaction was very positive.
Yeah.
Oh, yeah. Strong beats on adjusted EPS and revenue. The stock popped significantly after the call. It suggests investors are kind of looking past management's slightly more cautious, in-line tone.
So investors are buying the strategy, the story.
It looks like it. They seem to be recognizing the solid performance and seeing the potential in this ongoing evolution.
This quarter really does feel like a key moment for USANA.
I agree. It positions them at a critical juncture. You've got this company actively diversifying away from just its traditional direct selling roots.
Right. Pushing into these related wellness categories with Hiya and Rise Bar, it's a strategic shift that could really reshape their place in the market.
And those changes to the comp plan and the whole sales model, that's a clear attempt to recharge their distribution network, adapt to how things work now, especially with all the competition for entrepreneurs' time and energy.
Yeah, the big question is, can these changes really bring in and keep a new kind of brand partner? Someone who maybe operates differently than in the past?
That's the million-dollar question, isn't it? And then there's the product focus itself. Clean, Natural stuff, especially with Hiya doing well in kids' health. That lines up perfectly with what consumers want: more and more transparency, quality ingredients.
That could definitely be a competitive advantage, especially as people get pickier about health products.
For sure. And tying it all together, that stable financial footing, being debt-free, it just gives them such a solid foundation for all these investments and potentially for more M&A down the road.
And like you said, the market reaction, that big stock jump, suggests investors are buying this narrative. They see the long-term potential, even with management warning about some near-term margin stuff.
Exactly. They're looking at the transformation potential.
So for you, the listener, thinking about USANA's path forward, what are the key things to watch?
We'll definitely watch the immediate impact of that Q3 incentive rollout. Do those customer counts bounce back quickly? That's crucial.
Okay. What else?
Keep an eye on Hiya's growth. Can they maintain that strong trajectory? Any big news out of the global convention in August?
Right. New products or incentives announced there could be important.
And then, of course, the broader macro picture, especially in their key Asian markets. That always plays a role.
Got it. Okay, let's shift gears slightly. Time for our not financial advice segment. A bit of creative thinking from the investment committee corner.
All right, let's brainstorm. We've got USANA's strong balance sheet, their talk about opportunistic capital use, and the highest success.
Okay, so here's a slightly out there idea we're calling the Wellness Warrant Wonderland.
Intriguing name, go on.
Imagine USANA issues long-dated, deep-in-the-money warrants.
Okay, so long-term options issued by the company itself, giving investors the right to buy shares later at a set price. Deep in the money means that price is already way below current market value.
Exactly. Makes them attractive, signals confidence from USANA. And here's the twist. These warrants would be specifically tied to their future M&A plans and Hiya's international expansion.
Tying warrants to strategic goals. Okay.
You could set the strike price at a premium, maybe 15–20% above where analysts see the stock going in the next year or so.
All right. And the cash raised from selling these warrants?
Explicitly earmarked. Used for a significant strategic acquisition. Think a complementary, digitally native wellness brand, strong DTC presence, maybe in a hot area like personalized nutrition or gut health.
So using warrants to fund specific growth M&A, why warrants instead of just issuing stock or using cash?
Well, it leverages their capital strength, signals huge confidence in future growth from these initiatives, and it lets investors participate directly in that potential M&A upside without the immediate dilution you'd get from just selling more common stock right now.
Interesting. It's definitely bold. Combines that capital return idea with a promise of potentially transformative M&A growth.
It's speculative, for sure, but it just shows the kind of strategic options a debt-free company could consider. Food for thought.
Definitely food for thought.
All right, so let's wrap this deep dive up. To recap, USANA Health Sciences. A very solid Q2 2025. Strong top-line growth, impressive adjusted EPS beat.
And they're taking significant strategic actions. Those successful acquisitions are paying off, and they're doing a major overhaul of that core direct selling model.
Right. Near-term investments might squeeze margins a bit, we heard that, but the longer-term picture seems positive. They're aiming for modernized growth, expanding their reach in the health and wellness space.
It really is a story of strategic evolution and progress. Lots of moving parts.
Absolutely. Now, remember, everyone, the information we shared here, it's purely for informational purposes. It does not constitute financial advice.
Please, always do your own homework, your own due diligence before making any investment decisions.
We do value your insights, though, so feel free to share your thoughts on today's discussion. What stood out to you from USANA's earnings call? Let us know.